Hello and welcome to lesson 4. In our previous lesson, we learned what payroll is, how the payroll process works, and the difference between gross pay and net pay. Now we are going to look at something every payroll professional needs to understand, the difference between salary employees and hourly employees. Although they both receive wages from the work they do, the way their pay is calculated can be very different. So understanding these differences is essential because payroll calculations, overtime, holiday pay, and even deductions often depend on the type of employee you are paying. So by the end of this lesson, you'll be able to explain the difference between salaried and hourly employees, understand how each is paid, recognize the advantages and disadvantages of each payment type, and identify how payroll calculations differ. Ready to put your knowledge into practice? Complete the activities in this workbook before moving on to the next lesson. Writing down your answers and working through the exercises will help reinforce what you've learned and build your confidence in payroll. Remember, payroll is a practical skill. The more you practice, the more confident you'll become. Let's get started. A salaried employee is someone who earns a fixed amount of money each year. Instead of being paid according to the number of hours worked, they receive the same basic salary every payday. So for example, imagine Sarah earns 30k per year. If she's paid monthly, her basic salary each month is approximately £2,500, right? Whether Sarah works 37 hours one week or 40 hours the next, her basic salary normally remains the same. Of course, if she receives bonuses, commission, or unpaid leave, her pay may change, but her contractual salary stays fixed. Many professional positions are salaried, so including office administrators, payroll officers, accountants, HR staff, managers, teachers, IT professionals. These roles usually involve regular working hours and ongoing responsibilities. There are several benefits for this. For employees, the benefits are predictable monthly income, easier budgeting, often receive employee benefits, greater financial stability. And then the benefits for employers are easier payroll processing. I mean, once your employee is set up, it's just, you go from there. It's the same routine each month for that same employee. And then consistent staffing costs. And then one other benefit is simpler budgeting for the company. There can also be disadvantages. So employees may work additional hours without extra pay, be expected to stay late during busy periods. And then employers may continue paying full salary during quieter periods. That will be one of the disadvantages for them. And then they also, another one might be need to manage annual leave and sick pay carefully. So an hourly employee is paid according to the number of hours they work. So instead of receiving a fixed salary, the pay changes depending on the hours recorded. So for example, John earns £15 per hour. If he worked 40 hours, his pay is the 40 times the £15, which he will receive £600 for that 40 hours that he worked. And if he works 30 hours the following week, he'll maybe get the 30 times the £15, which is £450 that week. So his pay changes because it's directly linked to the hours he works. Hourly workers are common in industries such as retail, hospitality, restaurants, warehouses, manufacturing, healthcare support, cleaning service, or even temporary employment agencies. These jobs often have changing schedules. So here are the advantages for both employees and employers. And for employees, it's paid for every hour worked. Overtime usually increases earnings, flexible working arrangements, obviously, and then with employers, labor cost match workload, greater flexibility, easier scheduling during busy periods. The disadvantages of hourly employees. So employees may experience different pay each payday. So it's not fixed or basic at least, where you can say, I can at least budget on this X amount. It just depends on how many hours they've worked for that week or that month. It's, like I said, less predictable income and then fewer guaranteed hours. For employers, it may also mean track work hours accurately, calculate overtime, process varying payroll amounts as well. But this is where payroll becomes specifically important. So for salaried employees, payroll usually includes fixed salary, tax deductions, NI, pension, benefits, any bonuses, right? Since the salary is generally the same each pay period, calculations are often more straightforward. But for hourly employees, payroll may include hours worked, hourly rate, overtime, shift premiums, weekend pay, holiday pay, tax, national insurance, and pension deductions. Because hours vary, payroll professionals must carefully check timesheets before processing pay. Overtime is another important difference. Hourly employees are often paid extra when they work beyond their normal hours. For example, if your hourly rate is £15 per hour, your overtime rate is 1.5 times that normal time, that normal pay. So it's a 15 times 1.5. So you will receive £22.50 or £22.50 per overtime hour. If an employee works 4 overtime hours, so it will be 4 times the £22.50, which that person will receive £90 overtime pay for working for 4 hours. Some salaried employees may also receive overtime, but many professional roles do not. This depends on the employment contract and the company policy. So please make sure you read all of that information before signing that contract. Both salaried and hourly employees are legally entitled to paid annual leave. Although the way holiday pay is calculated may differ, salaried employees usually receive the normal salary while on leave. Hourly employees may have holiday pay calculated based on their average earnings or average hours worked in line with the UK employment law and company policy. Payroll professionals need to ensure holiday pay is calculated accurately. Payroll professionals must know which employees are salaried, which employees are hourly, the pay rates, their contracted hours, whether overtime applies, or any bonuses or additional payments. Using the wrong payment method can lead to incorrect wages, unhappy employees, and compliance issues. Accuracy is one of the most important responsibilities in payroll. So if we take a quick comparison between salaried employee and an hourly employee, you'll see in the first row, you'll see fixed annual salary under salaried employees. And then on the right, under hourly employees, you'll see paid per hour worked. So I'll just leave it on here for a few seconds or a minute, and you can just read through it just to do a quick comparison for yourself as well. Let's recap what we've learned. So a salaried employee earns a fixed annual salary that is divided across the year into regular pay periods. An hourly employee is paid according to the number of hours they work, so the earnings may change each pay period. Payroll professionals must understand the difference because they affect how pay is calculated. Overtime, holiday pay, payroll accuracy, and they also affect the employee satisfaction. Understanding these payment methods is one of the foundations of successful payroll processing. In the next lesson, we'll explore payroll terminology. We will learn the keywords and phrases used every day in payroll, helping you become more confident when reading payslips, payroll reports, and payroll documents. Please don't forget to download the workbook so that you can follow along in the series. I'll see you in the next lesson. Bye-bye.